Hello guys, welcome to Bhavna's Online Academy. So this is the part 2 of your IND 116, which is your leases. Like I told in the first video itself, in the first video we have discussed the complete theory related to this chapter, the basics theory. In the second part, which is this part, we are going to discuss the complete lessee accounting, which also includes your lease modifications. And after that, in the part 3, we are going to discuss the lessor accounting and the rest of the miscellaneous topics, right? Okay. So without any further ado, let's begin with the video. But before we start with this video, I'm going to explain the standard using the mind map, which is shown on the screen. If you want to access this mind map, the link of this will either be in the description box below. You can join my Telegram channel to get this mind map. And before starting with this video, I would highly recommend you to watch the part 1, where I'm including with the theory and concepts. I've also explained 18 illustrations. And in this video, we are going to start on the part after that. And we are going to also cover the illustrations related to lessee in this video. The complete illustrations we are going to cover, right? Yes. So without any further ado, let's begin with the video, guys. So now first topic that we are going to understand in lessee accounting. So who is the lessee? First, let's start with the basics. Who is the lessee? Lessee is the person who is going to get the asset which he can use. And in return of using this asset, he is going to pay something to the lessor. He is going to pay something to the lessor. Now, the amount that he is going to pay, we are going to understand about this in more detail now. So the payment that he is going to make to the lessor will be known as your lease payment. What is it going to be known as? It is going to be known as your lease payments. So what is lease payments? What are the amounts included in it? We are going to understand now. Okay. So suppose what happens, we'll take an example here. Okay. So here I'm taking an example where what happens is that we are a lessee. Okay. And we have taken a shop at the side of the road for lease. Okay. And in this shop, we are going to sell pani puri. Okay. So this is the business we are going to do. And here we are the lessee where we have taken the shop on lease. Okay, fine. So now to use this shop, suppose I've taken this shop on lease for suppose 5 years, okay, from the lessee. So for the 5 years for using this particular stall or for using this particular shop, I have to pay the lessor some rent or what we call as lease payments to him. Okay, so how are we going to calculate the value of lease payments? We are going to understand now. Okay. So starting with lease payments, what are included in lease payments, we are going to understand. Okay. So the first thing that is included in lease payments is your fixed payment. Okay. So suppose what happens is that suppose the pani puri shop, who is the actual owner, the lessor tells us that every month you have to pay some fixed amount. Okay, of 20,000, we'll take 20,000 or 2,000 per month if we have to pay monthly fixed amount for using that shop to sell our, products. Okay, that will be known as your fixed payment. Either it can be a fixed payment, like directly you can fix the amount and tell them that you have to pay this every month, or this fixed payment can also change over time because as you all know, today there is a lot of inflation. So to match with that, suppose the lessor might keep a condition that 20,000 per month you will pay, but this value will increase annually by 2,500. That is for the first year, every month you will pay 20,000 per month. In the second year, it will increase by 2,500. That means 22,000 per month you have to pay in the second year. So like this, there can be an annual increase in the price also. The fixed payment can be directly fixed for the entire lease term, or it can also change over time. Yes. So I hope you understood. So first, that is included in your lease payments. Then there is something known as your in substance fixed payments. So what is in substance fixed payments is, so here what happens is that what the lessor keeps a condition here. Okay. So what they are telling you is that, so talking about in substance fixed payments. So here I'll explain that with the help of an example. So as you all know, we have a pani puri shop which we have taken on lease here. So what the lessor tells us is that while you use this shop, you are going to make some sales. Okay. So every month you can pay me 15% additional amount of what the sale price you are going to make. Okay, suppose if you're going to make a sales of 10,000 rupees, then 15% of 10,000, which is 1,500, you will pay me every month. Okay, every month that you're going to pay me. Or if you're going to make suppose 1 lakh, then accordingly 15,000 you have to pay me as a fixed payment. So 15% on your sales you will have to pay me monthly. But here this is a variable fixed payment. This is a variable fixed payment. But here what this lessor does is that he also keeps another condition, that this condition is fine, but if the lease payment that you will make because of this condition, because of this 15% of sales condition, if the lease payment that you're going to give me is going to be less than 2,000, then in such case, I'll not accept that. Minimum 2,000 you have to pay me. If the lease payment which you're going to pay is going to be less than 2,000. Suppose he makes a sales of only 10,000. Okay. Then how much will he pay? He'll only pay 1,500. The lessor says, no, this I'll not accept. Minimum 2,000 you have to pay me. But if you are making a sale of 1 lakh, then 15% on it, 15,000 you have to pay. Okay. So whichever is higher, 2,000 or the other 15% on sales, whichever is higher, if they are telling you to pay, this is a kind of in substance fixed payment, because fixed 2,000 you will pay. More than that, it is possible, but fixed amount of 2,000 you are anyway going to pay. So that is also included as a part of your fixed payment. This is called in substance fixed payment. It looks like a variable payment, but in substance, if you see, it is an unavoidable payment. Every month 2,000 you have to definitely pay. Okay. Yes, so I hope you understood what is fixed payment. And whenever you're calculating fixed payments, now what is fixed payments? Fixed payment is an inclusion in your lease payments. So first add your fixed amount, including that if there is any in substance fixed payment, add that also, and minus your lease payments, reduce your lease incentives, sorry, not lease payments, lease incentives from it. So what is lease incentives? So lease incentives, so what happens is that we have this Pani Puri shop, I've been running it. So now what happens is, now I am in requirement of some seating space nearby. Okay, like this chair, tables and all I need nearby this Pani Puri shop. So here what happens is that if suppose the lessor comes up to lessor comes up to us and with a very good and kind heart, he tells us that, see, you need a seating space, right? So what I will do is for you, for the lessee, okay, so for your benefit, okay, I am going to create a seating space using my own money and give you, okay. But for now, what he is trying to say is, for now, you make the payment and build the seating space. But in the future, for this seating space which you have created, which is created by the lessee with his own money, lessor will reimburse that money in the future. Lessor is going to reimburse that money in the future. So here what happens? So even though you have made some payments here, since in the future, lessor is anyway going to reimburse it. Either in the future, lessor can reimburse it, or at the starting itself, lessor can spend the amount. Okay. So if in the future, lessor is going to reimburse it to you, then in such case, you have to reduce this lease incentives. So lease incentives are payment made by the lessor. Means the payment is made or payable by the lessor to the lessee. Okay. So he is going to make payment to the lessee. That means it's a benefit to the lessee. So therefore, you have to reduce it from your cost. Okay. So these lease incentives can be in the form of leasehold improvements also. Some to the asset, they are making some improvements. Suppose if there is a plant and machinery, for it to function very well, suppose they are changing some engine, that can be one leasehold improvement. Okay. So some leasehold improvement that lessor can do, and that will form part as your lease incentives, where the lessor is making the payment and the lessee can get the benefit out of it. Okay. So here, whenever such lease incentive is happening or some leasehold improvement is happening, you have to see whether this leasehold improvement is an asset for the lessee or is it an asset for the lessor. Now, if the seating arrangement is being made and given for the lessee, then it is an asset for whom? It is an asset for lessee only. It is an asset for lessee only. So in such case, you will deduct that from your lease payments. So such lease incentives, you will deduct from your lease payments. Okay. But if it is an asset for lessor, then it is not like an incentive to you. Only and only when whatever the lease payment, okay, or the lease incentive the lessor is giving to the lessee, only and only if it is a benefit to the lessee, you can deduct it from your lease payment. But if it is not a benefit to the lessee and if it is a benefit to the lessor himself, then this is not like an incentive. Okay, you're not going to get any benefit from it. So you can just account it as a reimbursement. Okay, so you can just account it as a reimbursement. If it is asset for lessor only, just record it as a reimbursement. Okay, and don't deduct it from your lease payments. Okay, so this thing you will have to remember about your lease incentive. Usually in your exams, it will not be much complicated. Directly, they'll tell you that this is a lease incentive and you have to directly reduce it from your fixed payment. Okay, so first part of lease payments we have understood, which is your fixed payment. The second part is variable lease payments. The second part is your variable lease payments. Okay, so here what happens is that this variable lease payment can depend on an index or rate. Okay, suppose what happens is that here instead of them telling that they will annually increase the, they'll annually increase the lease payments by 2,500, they will tell you that the increase or decrease in lease payments will depend on some index or a rate. Okay, so suppose there is something known as a consumer price index. There is something known as a consumer price index. So what the lessor can tell you is, you have taken the Pani Puri shop on lease from me. Okay, every year pay me, every month pay me 20,000, 20,000, 20,000. So when we were starting out, the CPI was 100. Okay, when we were paying 20,000 per month, our CPI was 100. What the lessor told us was, depending on the CPI in the future, your your lease payments will also get adjusted accordingly. Your lease payments will also get adjusted accordingly. Suppose what happened from the third year, the CPI changed to 200. So when the CPI was 100, what was the lease payment you were making? You were making a lease payment of 20,000. Now when the CPI has become 200, your lease payment will also change. It will be 20,000 divided by 100 into 200. Okay, so your lease payment here will become 40,000. So your lease payment will also get increased. So depending on an index or rate, your lease payment in the future will decrease or increase. Okay, so it can either be like a consumer price index or something like a interest rate. Okay, so depending on those interest rates or those rates or indexes, your lease payments will change. So this is known as your variable lease payments. So what they are saying is, when you are talking of variable lease payments, there are two conditions that it has to fulfill. Then only you can record it in your books. One, it should depend on an index or rate. Okay. And the second one is that you can record it as your lease payments. One, it should depend on an index or rate. Second, it should be an unavoidable and it should not depend on any future activity of the lessee. So according to lessee, it should not change. It should not depend on any activity of the lessee. The rate should not be like a rate on sales or a percentage on profits or a percentage on performance. No, it should be an independent rate. It should not depend on any future activity done by the lessee and it should be unavoidable. So if all these conditions are fulfilled, it will be known as your variable lease payments and it will get included as a part of your lease payments. Okay. And the next one which will get included as part of your lease payments are, in case if there is an exercise option where what they are saying is, at the end of the lease term, you can purchase it. Okay, you can purchase the asset. That means if the lessor is giving us an option that at the end of lease term, you can purchase a Pani Puri shop for yourself. If we are reasonably certain that we will exercise this option and purchase the Pani Puri shop, then in such case, you can record that value as your lease payments because you are going to pay for it in the future. Okay, that is it. Then the next thing which will get included in your lease payment is your termination penalty. In case if there is a point that you can terminate, okay, after maybe 4th year or 5th year, you can terminate this lease contract. Suppose the lease contract is taken for 10 years. Okay, but what they are telling is that after 4th or 5th year, you can terminate this lease contract. But if you're terminating this lease contract, in such case, you will have to pay something known as a termination penalty. You have to pay something known as a termination penalty. That means this is a cost to you. Then in such case, if you're reasonably certain that you're going to terminate the contract, then include it as a part of your lease payment. The termination penalty, include it as a part of your what? Lease payment. Okay. And the final one is residual value guarantees. So what is residual value guarantee mean? Suppose you're going to use this Pani Puri shop for 10 years. Okay. What this lessor might expect is that the lessor might expect that at the end of this 10 years, if I am able to sell the shop, if I'm going to go and sell this Pani Puri shop, I will fetch around 10,000 rupees. I will fetch around 10,000 rupees. Okay. So here what happens is that if suppose there is a lessee, okay, and lessee also agrees that he is going to use this shop in such a manner that at the end of 10 years, yes, lessee is also agreeing that he will use the shop in such a manner that at the end of 10 years, if the lessor is going to sell the shop, he will get 10,000 rupees. Okay. Suppose what happens is that due to this lessee has not used the shop in the proper way, he did not clean it properly, he did not maintain it properly, or for whatever reason it may be. Now at the end of 10th year, what has happened is that at the end of 10 years, what has happened is that when the lessor is going to sell the shop, he was only able to fetch 6,000. Correct. So here, because lessee has promised that he would use the shop in such a way that he'll be able to fetch 10,000, but now it is only fetching them 6,000. Here, the lessee will be liable to bear the decrease in the residual value, liable to bear the decrease in the residual value. So the 4,000, the lessee is going to bear. So that value lessee is going to bear. So this is what is known as your residual value guarantee. Like here, the lessee acts as a guarantee that any price decrease from what is the expected residual value, he will bear it and he will pay for it. So that is known as your residual value guarantee. So if the lessee, so here from the lessee's perspective, whenever you're calculating your lease payments, you have to include the part of residual value guarantee, which you think that the lessee is going to pay, which you think that the lessee is going to pay. So if I'm the lessee and I think after 10 years, I have guaranteed that he'll get 10,000, but I know that I'll not use the shop in such a way. So the value might go down till 6,000. So I'm expecting that 4,000 I might have to pay in the future. So that 4,000 you can include in your lease payments. Okay. Yes. So then from the perspective of lessor, whenever you're doing lessor accounting, we'll understand about this. But for now, I'm saying here, when you're accounting for lessee, only the residual value guarantee that the lessee is going to pay, he will include that in the lease payment. But when you're talking about lessor's perspective, lessor will include the entire residual value guarantee, which he is either going to get from the lessee or any other unrelated third party. So anybody can guarantee, okay, that for this asset, you will be able to fetch this much. If you're not able to fetch, I'll pay for it. So whoever has guaranteed to the lessor, it doesn't matter. The entire guaranteed residual value, lessor will record in his books. Whereas the lessee will only include the part of residual value guarantee, which the lessee is going to pay. Okay. Yes, I hope you understood this. So that residual value guarantee also, we are going to include it in our lease payments. So what and all are included in our lease payments? So fixed payments, then your variable lease payments, exercise option of purchase if you are certain to exercise, termination penalty if you are certain to terminate, and residual value guarantee. Yes. Okay, so now that we have understood what the lease payments mean, let me tell you how you are going to record it in your books. Let me tell you how you are going to record it in your books. So what happens, suppose we have taken a lease for suppose 4 years, okay? So we have year 0, year 1, year 2, year 3, and year 4. So here, your 0th year means the date of your commencement, the date when you're going to record it in your books. So here we have taken this Pani Puri shop on rent, and we have, the lessor has told us that by every year end, you have to pay 50,000, that at every year end, you have to pay us 50,000. So year 1 end, you will pay 50,000, year 2 end, you will pay 50,000, year 3 end, you will pay 50,000, and year 4 end, you are going to pay 50,000. But on the commencement date, you have to record this in your books, that in the future, you're going to make these payments, correct? But will you directly record it like 50,000 plus 50,000 plus 50,000 plus 50,000? So 2 lakh in your books. So 2 lakh in your books, are you going to directly record as 2 lakh in your books? The answer is no, you will not directly record 2 lakh in your books, because you all know 100 rupees today and 100 rupees tomorrow is not the same. 100 rupees that you're going to pay today and 100 rupees tomorrow is not the same, correct? So here what you are going to do is you have to bring all of these values to the present value, to the value today. Okay. So if today you had made all of these payments, okay, so from the future, you have to pull up all these 50,000s to the present at a discount rate, and you have to record it in your books. Okay. So this is what you are going to do. So in your books, whenever you are recording these lease payments, you have to record the present value of lease payments, and these present value of all the lease payments will be known as your lease liability. It will be known as your lease liability in the book. So what will happen when you are doing this balance sheet, on your liability side, you are going to write lease liability, and the present value, whatever of the present value of the lease payments are, that you will record it in your books. Okay, so I hope you understood this. So see, your lease liability, you will record it on your left hand side, because this is the payments you have to make in the future, and on the right hand side, the asset you will record, and the asset will known as your right of use asset, because only you have the power to use the asset. So that you will record as an asset, and how this value will be calculated, we will understand in the later part. Okay. So now example number 2. So here that was a simple example. That was like you don't have variable lease payments, so you don't have any other clause. Just directly 50,000 every year you're paying. Now suppose what happens here is that here this time we have decided that we are going to have 5 years of lease term, and usual lease term every year you have to pay 50,000, 50,000, 50,000 and so on. Okay, so until 5 years, every year end you have to pay 50,000. Okay. So usual case, what you would have done, you would have pulled all these 50,000 to the present, and you would have found out the present value. But now here what they are telling is that there is a lease incentive which the lessor is going to pay and give you. So this is for a value of 10,000 rupees. So here this 10,000 rupees, if that you are going to get at the first year end, if you're going to get it on the first year end, then this 10,000 rupees you have to reduce from your lease payments. That's what we are read there, correct? So 50,000 minus 10,000 will be your net lease payments for the first year. So what is the net here? So it is 40,000. So 40,000 you will pull to the present value and find out. Okay. Yes. In the second year, you don't have anything. Third year, you don't have anything. Fourth year, you don't have anything. What happens is in the fifth year, suppose if we get the option of purchase and we are very certain that at the end of fifth year, we are going to purchase it. At the end of fifth year, we are going to pay 40,000 and we are going to purchase that. Okay. So then in such case, how are you going to find out the lease payment of fifth year? So it will be 50,000 plus 40,000, which is 90,000 that you are going to pay in the fifth year, which is your lease rental plus the purchase value you are going to pay. This you have to pull to the present value and show it in your books. Okay. Then what is there? There is another clause where what might happen is that suppose this lease was for 6 years. Okay, and until 6 years, you were told that you will pay lease rental of 50,000. But what happens here is that you are going to terminate after fifth year, and there is a termination penalty because of that, because you're not using it for 6 years and you are going to terminate it at fifth year end itself. So for that, you have to pay a value of 10,000. So 50,000 lease rental you have to pay. Along with that, a termination penalty of 10,000 you have to pay. So 50,000 plus 10,000, 60,000 you are going to pay. Once again. Yes. So 60,000 you are going to pay, and the 60,000 you have to pull it to your present value. So now just I've taken like a consolidated here. So in first year you'll pay 40,000, second year 20,000, second year 50,000, third year 50,000, fourth year 50,000. Fifth year, suppose you're paying 1 lakh, and sixth year, since it is terminated, you're not paying anything. So all these values you have to pull to the present value and show it in your books on the 0th year, that is on your commencement date. Okay, so this is what you're going to do. You have to find out the present value by using a discount rate. And the discount rate usually is directly given in the question, and we are going to read more about it in the later part. Yes. So when you're calculating these lease payment, there are a few exclusions that you have to keep in mind. That means when you're calculating this lease payment, do not take this into consideration. Directly ignore it. Directly what? Ignore it. So first is payment related to non-lease component, if any. Okay, only the lease components you have to take into consideration. If you are making any payments related to a non-lease component, that means suppose for goods or services, if you are paying something, then don't include it in your lease payment and find out the present value and show as lease liability or ROU asset. Just ignore it. It will be accounted as per other INDs. It will not come here. Then variable lease payment. Variable lease payment only which is dependent on index or rate will come under our IND AS 116. Which is not dependent on index or rate. Here, for this value, you will not include in your lease payments, nor will you find out the present value for it, nor will it be recorded as your lease liability or your ROU asset. Here, this variable lease payment, if you are making any, suppose here there is a variable lease payment where what happens is that the lessor has told us that you are running this Pani Puri shop very good. Okay, so seeing this kind of shop, he assumes that there will be a lot of sales. So he tells you that every year you have to give us 2% of the sales also as variable lease payment. This is not in substance. Okay, here there is no specific limit that you have to pay this much definitely. If there is zero sales, then the lessee also will not pay anything. So there is nothing fixed here. Okay, so this is just a normal lease payment where it is neither dependent on index or rate and nor there is anything which is fixed here. Okay, that means it is not dependent on your CPI or it is not dependent on your interest rate. It is like 2% on sales or 2% on performance or something like that. Then in such case, what you will do is how you are going to record it in your books is you will record this variable lease payment in your P&L account as an expense. This will not come in your balance sheet at all. Okay, so if there is a variable lease payment which is dependent on usage or performance, it is going to be recorded in your P&L account. Examples, 15% of sales every year. Okay, so if what happens is that if after some point of time, if this variability has been resolved during the lease term, and if this suppose becomes something like a fixed payment or something, if you are making a modification in the lease terms, and if this variable lease payment becomes your fixed lease payment, then you can show it as your lease payment in your balance sheet. Otherwise, until and unless it is not dependent on index or rate, and neither it is fixed, it is going to come under your P&L as your expense. Okay, so I hope you understood this. Yes. So here when I told you that it is going to be dependent on index or rate, what does this index or rate? Here rate means rate which helps us to equalize the inflation, like I told you, happening in the world, such rate is considered in the lease payment. So anything that is helping us to equalize the inflation, such rates can be if 15% on sales or 15% on performance. Is it a measure to equalize the inflation which is going to happen in the future? The answer is no. So therefore, it will not be included as your variable lease payments which is dependent on index or rate. Okay. So I hope you understood this. So this was all about your lease payments. Yes? Is okay, fine. So moving on to the next part, there is one topic. So here what we are basically discussing is we are basically discussing different parts of a topic. And all of this, when we are understanding the practical concept, everything will come in consolidation in your question. You will be able to understand it better. For now, we are going to understand it part by part. And we are not going to mix anything with each other. This you are going to understand in the lessee accounting. Okay, the practical portion of it. Yes. So now we are going to understand something known as initial direct cost. So what is initial direct cost? The definition of initial direct cost is that any incremental cost of obtaining a lease. Okay. If such a cost was not incurred, you could not have obtained the lease. Suppose what happens is that I was in a search of this Pani Puri shop, okay, for a lot of time. But what happened was that when I was in the search of this shop by myself, I was not able to find any good shop or a good size of shop at a good location. So what I did was, to find the shop, I hired an agent. And this agent helped me to find a shop which is good in size and is also at a prime location. Now here what has happened? This is an incremental cost of obtaining a lease. Normally for obtaining this lease, I have to do lease payments and other payments. Okay, but this hiring agent to find out this lease is an incremental cost. It is an extra cost for obtaining the lease. And if I had not incurred this cost, then in such case, I could not have obtained this lease. Correct? Yes or no? So something cost like these will be known as your initial direct cost. Initially you do this cost, but it is directly relating to the lease itself. So it is known as your initial direct cost. Example I've given, see, agent helping the lessee to find the lessor and vice versa. Here the agent commission which you are going to spend. So for this agent, you have to spend some commission. Okay, you have to give some commission. So this commission will be known as your initial direct cost. Yes, I hope you understood this. So what and all are included in your initial direct cost? A few examples we are going to see here. First is your commission, which we understood here. Example, your if there is some employee, okay, and suppose what happens is that employee is acting as a selling agent here. That means you have a company in that to find out your prospective lessor or find out your prospective lease. Your employee has suppose acted as a selling agent, and for them you're giving some commission, or you have hired an agent to find out your lessor. So those commission will get included here. Then if there is any legal fees which you have to incur to execute the lease, suppose making some documents of lease or lease agreements, or hiring someone to do the legal work. So all these legal fees will also get included as your initial direct cost. Then lease document preparation cost, okay, incurred after execution of lease. So after the lease terms are agreed on, you have to prepare a lease document, right? So when the lease is final and done, you are going to both the parties have decided and agreed that this lease is going to happen. After that, for document preparation of the lease, you are incurring some cost. Then in such case, that will also get included as your initial direct cost. Then the next is if there is any tenant, okay, suppose this Pani Puri shop, this agent, I have found out a Pani Puri shop. But what happens is that already one more person was using this Pani Puri shop. Now, to give this Pani Puri shop to us, to give the Pani Puri shop to me, the lessor, what he does is that the lessor or suppose we, okay, what we do is that we are making an extra payment to the lessor. So that what he does is that he throws out the person who is existingly using that shop and helps us to come into this shop. Okay, so any payment that we are making for the existing tenant to move out, so that the lessor is able to send out the existing tenant. Okay, for that some payment we are doing extra payment, and that will also get included as your indirect cost. Initial direct cost, not indirect cost, initial direct cost. Okay. And then it can be the guarantee of residual asset by unrelated third party. So for a third party to, give guarantee for that asset, we are paying that third party some commission. Okay, that, can you please guarantee for this asset? Now, suppose lessor keeps a condition that only and only if you guarantee a certain amount for this asset, I'll give you that asset on lease. And we don't have any money. So there is a third party which comes into picture and they tell that we will guarantee that, we are going to pay a certain amount. This third party is not a fool to just come up and tell and give such promises. For that, we have to pay him or her something, correct? So that he is able to give a guarantee. So in such case, for that, if you are giving him something, the third party, then in such case, that is also an initial direct cost. I hope what and all are included in your initial direct cost. We are going to now understand what is going to be excluded from your initial direct cost. Suppose if there is any employee salaries that is being paid, okay, where the employees are not helping us to obtain a lease or act as obtain a lease basically, then in such case, if they are general employees, their salaries and all, you will not include in initial direct cost. Suppose then there is legal fees, but this legal fees you have incurred before the execution of lease. The lease is not yet sure here. Okay, you're not definite that the lease is going to happen or not. But still for some paperwork, you have hired some legal person and you have incurred some legal fees, and this and all will not get included. Only after the execution of lease, whatever lease legal fees you are, paying out, that only will be included in your initial direct cost. So if there is some negotiation of lease term and conditions, and for that, if you're paying some cost, neither that will be included. Advertising cost will also not be included. Suppose you're advertising that, I am looking for a Pani Puri shop. If there is any prospective seller, please come up to me and give your shop on lease. So even if you're advertising something like this will not be included. Then depreciation and amortization cost will also not be included. This will come under your exclusions. Yes. So I hope you understood what is initial direct cost. Fine. Then we are going to understand about the next is involvement of lessee before the lease date. So what is involvement of lessee before the lease date? So here we are going to talk about a topic which is known as sale and lease back. Here we are going to talk about a topic, sale and lease back. This actually will again come as a broader topic when we are talking about lessor accounting. In that, in the end, sale and lease back, another topic is going to come. That will be like a main topic. But here, let's just understand the point related. Okay. So here, what is sale and lease back? So here, sale and lease back, what does it mean? We'll understand. Okay. So here, if the lessee controls the asset before the transfer to lessor. So here, what happens is that there was a lessee, suppose person A, and that there is person B, which is the lessor. First, person A was having a car. The person A sold this car to person B. Person A sold this car to person B. Here the person A is who? Seller. Person B is who? Buyer. Then again from the person B, person A is again taking this car on lease. Taking this car on the same car which he sold on lease. So here person A becomes the lessee and person B becomes the lessor. So this is what is known as your lease back. So here the lessee had the control of the asset before transferring to the lessor. And when it is not a sale or lease back, so here what happens? Lessee obtains the legal title but no control over the asset before the asset transfer to lessor. So here, what they are saying is, how are we going to account for sale and lease back? We'll understand in later part of the chapter. But when it is not a sale or a lease back, this is what the normal conditions are. Okay, normally this is how a lease happens. Sale and lease back is an exception. When it is not a sale and a lease back, normally what we have studied until now, like that you are going to account as a normal lease. You have to account it as a normal lease. Okay, you'll understand about it in the later part of the chapter. If you have not understood it now, it's okay. Now let's talk about discount rate. So when are we going to use this discount rate? When we have to pull down all the lease payments which are going to happen in the future to the present value, we pull it using a discount rate, and this discount rate is what we are going to understand now. Okay, so in the question there can be two discount rates which are given. One is interest rate implicit in the lease, which is also known as IRR. What is this? Interest rate implicit in the lease. Or another thing which can be known as your discount rate is the lessee's incremental borrowing rate. Okay, let me explain what this is. Just give me a minute. Okay. So now talking about the interest rates. So I've told you that there are two kinds of rates which you can use as your discount rate. One is your interest rate implicit in lease, and the next one is your lessee's incremental borrowing rate. So first, let's understand what is interest rate implicit in a lease. Interest rate implicit in a lease is such a rate. It is such a rate at which what happens is that whenever you take the present value of lease payments, and if you add the present value of unguaranteed residual value. So what does your present value of lease payment include? All your lease payments, all the kinds, fixed payments, variable payments, termination penalty, purchase price, your residual guarantee value, everything will get included in your lease payments. Okay, present value of that plus present value of any unguaranteed residual value if it is there. If you add those both at that rate, it will be equal to the fair value of the asset plus any initial direct cost of lessor. So it is a rate at which what happens? If you take the present value of all your lease payments and your unguaranteed residual value, if you find out the present value of this, at that rate, it is going to be equal to the fair value of asset in the market plus any indirect initial direct cost of lessor. If there is any initial direct cost of lessor. So if you're going to add both of these, whatever, suppose you're getting a value of 1 lakh, the fair value of the asset is suppose 90,000, and the lessor incurs the initial direct cost of 10,000. Suppose it is 1 lakh. Okay. And if your lease payment is suppose through the years, the lease payments you're going to make is suppose 3 lakh rupees. and the unguaranteed residual value is suppose 10,000 rupees. Okay, so here at the rate where this 3,10,000, if you are going to pull it to the present value, it is going to become 1 lakh. So it is a rate at which this 3,10,000, if pulled out at the present value, will become 1 lakh. So that rate or that percentage will be known as your interest rate implicit in lease. That will be known as the interest rate implicit in lease. Usually this will be directly given in your question. Usually it will be given directly in your question. It's also many might have a doubt. How are we going to find out the present value of UGRV? What is unguaranteed residual value? So I've told you, when I was explaining an example here related to residual guarantee value, that if the lessor is expecting a total of 10,000, and out of that 10,000, suppose we have given them a guarantee that minimum 4,000 we will pay, then the rest of it 6,000 which is left unguaranteed, it will be known as your unguaranteed residual value. So residual value minus whatever has been guaranteed from it. If you remove that value, guaranteed residual value, you will be left with your unguaranteed residual value. Okay. Yes, I hope you understood this. Usually the interest rate implicitly in lease is given directly in the question itself. And this should be your first priority. If in the question both of these are given, IRR should be your first priority. IRR should be your first priority. Okay. Yes. Now, speaking of lessee's incremental borrowing rate, what is lessee's incremental borrowing rate? Suppose if you're not able to find out the IRR, if it is not given in the question, another thing which might be given in the question is the lessee's incremental borrowing rate. So, lessee's incremental borrowing rate means it is a rate of interest at which has similar lease term, security, value, and economic environment. If there is another person who is living in this world and they have given a similar kind of lease, at the same lease term, at the same kind of security, at the same value, and at the same economic environment, if they are going to give it at a lease, okay, someone in the same universe has given at the same conditions at what we have given these, they have also given it on lease, the rate which they are using, you can also use that rate and discount. So the rate at which has similar lease terms, similar security, similar value of the asset, and similar economic environment, then in such case, it can be known as lessee's incremental borrowing rate. Okay. So either this or that you can use to find out your discount rate. Give first priority to IRR if both are given in the question. If only one is given in the question, take that. Okay. Yes. Then now talking about the other topics, so remaining what we are left to understand is there will be two terms which will be usually you'll get to see in the question. One is useful life and the other one is economic life. Okay, so here first let's understand what is economic life. So economic life is a period over which asset is economically usable. Economically usable means you will be able to generate benefit out of it. Okay, so that amount of period, suppose if the asset's useful life might be 10 years, but you will be economically able to generate, you will be able to generate the benefit from it only for suppose 8 years. Then in such case, economic life will be 8 years and useful life will be 10 years. Okay. Another example of it is number of production units expected to be obtained. So here what they are telling is that suppose the useful life of the asset might be 10 years. And they might tell you that in this 10 years, you can generate 10,000 units of output from the machine. Okay. But what you have done is in 5 years itself, you have generated 10,000 units of output from it. The maximum output the machine could produce, you have overused it and you have reduced it on it in 5 years itself. Then in such case, economic life will here be just 5 years only. Okay, so it can be dependent on your production units, or it might be how much you are economically able to use it, or how much, how much you are economically, how much benefit you are able to get from it. Okay, so these were all the topics first that we had to understand before we start the core concept of lease accounting. So we understood lease payments, initial direct cost, involvement of lessee before the lease date, where we spoke about sale and lease back and not sale and lease back. Then other topics where we understood about economic life. And you all know what is fair value. Fair value is the amount at which the asset can be exchanged or a liability can be settled between knowledgeable willing parties and arm's length price. So in arm's length price, if there are two parties who are coming together and they are setting up an amount, that this at this amount we can exchange the asset, or at this amount we can settle a liability, and that will be known as your fair value. Okay. So I hope you understood that. Okay. So now that we have completed this, before we move on to the core concepts of lessee accounting, let's first solve all the illustration related to these topics. It is from illustration 19 to 26. Let's first go and solve that. Okay. So let's now start with illustration 19. Okay. So illustration 19 is related to your fixed payment. So here what they are telling in illustration 19 is there is a 10-year lease, and they have fixed annual lease payments of 2 lakh. So every year the lessee has to pay 2 lakh rupees here. Okay. And they are selling, and they are telling you that as per terms of the lease agreement, annual fixed lease payment comprise. So in this 2 lakh, there are 2 parts. In this 2 lakh, the first 1,70,000 is related to the rent of the asset, and the remaining 30,000 is related to real estate taxes. So here they are asking you, what are the fixed lease payment for the purpose of classifying the lease? So how much should you take as fixed lease payment from that 2 lakh? 1,70,000, sure shot you are going to take as a fixed lease payment because it is directly related to the lease and you are paying it annually. Okay. What about the 30,000? The 30,000 is what? It is your real estate taxes. So this is neither a lease directly, nor it is a good and service. So neither this is a lease component nor it is a non-lease component. So here what we have read in the earlier part of the video, that this 30,000 what we are going to do, we will consider. So here what we have to allocate this between the lease and the non-lease component. Here 30,000, in this question, is there any non-lease component? The answer is no, there is only lease component. So this 30,000 you will directly allocate it to the lease asset. So 1,70,000 plus 30,000, entire 2 lakh is related to the lease asset only here. So the entire 2 lakh will be your fixed lease payment. Okay, I hope you understood that. Illustration number 20. So illustration number 20, here they are telling you that there is a 7-year lease of a machinery. Okay, and the lease payments as are follow. So here they are telling you that here, if the Q uses the machinery within a given month, then an amount of 2,000 accrues for that month. Okay. So what they're telling is there is a month, and if within that month itself, if they start using it, suppose January. In January itself, suppose they start using it, then amount of 2,000 accrues for that month. For that month, they have to pay 2,000. If Q is not using the machinery within the given month, that within January, if they're not starting to use this machinery, then an amount of 2,000 will accrue for that month. Then in that month, they need not pay 2,000. If they pay 1,000, it is enough. But minimum 1,000, they have to definitely pay. So here, what is the lease payment you have to see? Here, if you see what they are telling you, this is the example of an in-substance fixed lease payment. That right now, we don't know when we are going to use this asset. Okay. Here, we are not sure when we are going to use this asset. If we are very sure that we'll start using it in January, then you can write it in your books as 2,000. But here, since there is no indication of whether they are sure whether they'll use or not, so we are going to record this 1,000 rupees as a lease payments here, because this 1,000 rupees is your in-substance fixed lease payment. That means whether or not you use the machinery, you have to definitely pay this 1,000 rupees. Okay. So this will be included as a part of your lease payment. Hope you understood that. Okay. Next is illustration number 21, where they are telling you that there is a 5-year lease and you have taken an office space for a 5-year lease. Okay. Here the initial base rent is 1 lakh per month. So every month you have to pay 1 lakh for that, and the rents will increase. So here the rent is going to increase by greater of whichever is higher. There are 2 options, and whichever is higher, by that the rent will increase. It is either 1% of P's generated sale, either 1% of sales or 2% of previous rental rate. Either what they are saying, 1% of sales or 2% of previous rental rate. Okay. So either one of this, whichever is higher, according to that, annually your rent is going to increase. Right now, the rent is suppose 1 lakh. So here they are saying, what are the lease payments for the purpose of measuring the lease liability? So for measuring the lease liability is nothing but your present value of lease payments. So for measuring the lease payments, which one are you going to take into consideration? I've already told you, whenever we are talking about a variable increase, you will only take such a rate which is dependent on either an index. You will take the percentage which is either dependent on index or rate. Here in this question, there is no index, but you will take the variable payments into consideration if it is only based on the rate, which will help you equalize what? Help you equalize your inflation. And this rate should not be dependent on your usage or any kind of performance, because this will not help you equalize the inflation. So here, this 1% of sales you will not take into consideration, and you will take 2% of previous rent rate into consideration, because sales, even if you're not going to make any sales, then there'll be no, no payment that you're going to make. The payment is going to be zero then. Correct. That is not possible. So here 2% of previous rent rate you will take into consideration. So here that will be your lease payment. So fixed monthly payments of 1 lakh rupees plus minimal annual increase of 2% of previous rent rate, because here what they are saying, P is required to pay no less than 2% increase regardless of the sales activities. Therefore, the minimum level of increase is the substance fixed lease payment. So here what they are telling is that why usually you will not take sales. That is one reason. Another reason what they are quoting in the answer is that irrespective of whether there is sale or not, you have to pay a higher of this. So anyway, if this is not going to happen, minimum you are going to pay 2% of the previous rent rate. Even if sales is zero, you have to pay this. Okay. So this is like an insubstance fixed payment. So you will take this into consideration. Okay. I hope you understood this. The next question is, so here what happens in illustration number 22 is that they lease a production line. Okay. And this production line they have taken on a lease, and the payments, lease payments depend on the number of operating hours. Depending on the number of hours you're going to use this production line, you are going to pay lease payments for it. And what they are selling is you have to pay 1,000 per hour of use. For every hour you are using, you have to pay 1,000 rupees. Annual minimum payment is 10 lakh rupees. Okay, here what they are telling is minimum you have to make a payment of 10 lakh rupees. Okay, so expected usage per year is 1,500. So here what they are telling you is that here you have to find out and tell them what is going to be your lease payment. So what they are telling you is that for every hour of use you have to pay 1,000 rupees, correct? And you have to minimum pay a value of 10 lakh every year, irrespective of the hours that you're going to use. And in your entity, you are expecting that you will use it. Okay. Yes. So here what happens? Here, if you are going to use it for 1,500 hours, then in such case, if you are expecting to use for 1,500 hours multiplied by 1,000 per hour, you will be paying 15 lakh rupees. But this is just the expected usage. You don't know how much you're going to use. Okay, so minimum, since here you are paying 10 lakh rupees, and this is kind of like a fixed payment for you, that no matter what, no matter how much hours of usage, even if it is 800, 100 or 0 hours of usage, you will still have to pay a minimum of 10 lakh rupees. So this 10 lakh will be your lease payment. This 10 lakh will be included in your lease payment. Okay. Illustration number 23. Okay, this illustration is about your variable lease payment. So here they are telling you that you have a 10 years lease of property, and this lease payment, you have taken a property on lease for 10 years. The lease payment for the first year of that property is 1,000 rupees. And this 1,000 and your lease payments are linked to consumer price index, that depending on some index, your lease payments in the future is going to change. Okay, so the CPI at the beginning of first year is 100. So here what they're telling, at the beginning of the first year, your CPI is how much? 100. Lease payments are updated end of every second year. That means if it is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And every year if you have to pay 100 rupees, sorry, 100 or 1,000 rupees, suppose that was what was initially decided. And at the beginning of first year, your CPI was how much? 100 rupees. And what you do is at the end of every second year, that means every second year end, what you do here is that you see what is the CPI and you accordingly update your lease payment. So at the end of year 1, your CPI is 105. At the end of year 1, your CPI is 105. So our question here is that, before I answer this question, let me tell you the concepts. Okay. So here what will you do is that on 0th year, when you are calculating the present value, you will do 1,000 for year 1, 1,000 for year 2, 1,000 for year 3, 1,000 for year 4, and 1,000 till year 10. So you will pull all of these thousands to the present value and find out your, pull it to the present today and find out your present value of lease payments. Now here, whenever in the future the CPI is changing, even if you know, in the question, we'll know at the start of the question itself that the CPI is going to change. So you should not change it at the start. What will happen in real life? In real life, will you know the CPI is going to change after 2 years? No. So you need not account it like that. In the starting, in the 0th year, take at whatever initially decided your lease liability was, first pull them all to your present values. Now what happens is that, when are you going to remeasure this liability? When are you going to remeasure this lease payments? You will remeasure it at the end of every 2 years. But at the end of first year itself, your CPI has changed to 105. Will you now take this into consideration? The answer is no. Here you will not remeasure it. You will come to year end 2, and after coming to year end 2, at the end of year 2, which is nothing but the start of your year 3, you are going to remeasure your lease liability, and you see what is your lease liability or your lease payment is. So first it was 1000 when the CPI was 100. Now the CPI has become at the end of year 1, the CPI is 105. Just ignore this. At the end of year 2, the CPI is 108. So take this into consideration. So into 108, 1080. Yes. So 1080 is your lease payment. 1080 is going to be a lease payment further on. So from year 3, 4, 5, 6, 7, 8, 9, for every year, now you're going to pay 1080. So now what you have to do? You have to cancel all of this, and you have to bring this 1080 till year 10. From year 3 to year 10 to present value, and you have to change your present value in your books also. Okay. So I hope you understood this. So here the answer is nothing but 1080 per year. Year 105 will not take into consideration. Since you are remeasuring at every second year end, you have to take that value only. Okay. So illustration number 24. So illustration number 24, here this is variable lease payment, but here it does not depend on an index or rate. So here what happens is there is entity XYZ. It grants its customer ABC. So XYZ is the lessor and the customer ABC is the lessee. So it grants customer ABC a right to use a medical laboratory machine at no cost, and the customer ABC purchases consumables for use at 100 each. So here what they are telling, this is usually an industry practice where what happens is that if there is a lessor and this is a lessee. Okay, and here what they do is what their selling product actually is they give, suppose some, we'll take this as some ointments or lotions or some potions basically. Okay, some kind of potions. Okay, and these are like consumables. Here what you do is that this can be used in a mission, in a laboratory mission. This can be used in a laboratory mission. So here what happens is that this lessor has given this mission to lessor. Sorry, here it's lessee. Okay, this lessor has given this mission to lessee at no cost. Okay, for him to just use it. But instead what they are telling is they will give this consumables also to lessee, and for this consumables they are going to charge rupees 100 each. For this they are going to charge rupees 100 each. Okay, so here what they are telling is that this consumables can only be used for that equipment. These consumables can only be used for this machine and cannot use another consumables as substitute. So to use this machine, you have to only use this consumables. So here this machine is not going to make the lessor money, but this consumables is going to make him money, because in this machine, the lessee can only use these consumables and there are no other consumables which he can use. So customer ABC estimates that it is likely to purchase at least 8,000 units of consumables. So lessee is estimating that he will minimum purchase 8,000 units of consumables. Expect. Okay. 8,000 units of these consumables. That means he might have to pay 8,000 into 100, which is around 8 lakh rupees to the lessor. Okay. Here there is no residual value guarantees or any other form of consideration. Only that 100 rupees is the consideration here. So here whether these payments affect the calculation of lease liability and ROU asset. So here what they are telling is that before going to this line, here they have also told that the customer ABC has appropriately assessed that the arrangement contains a lease of medical equipment. So here this mission is like a medical equipment, this mission. Okay, this equipment is like a lease to the lessee. It is like a lease to the lessee. Okay, so here what they are asking is whether these payments is going to affect the calculation of lease liability and ROU asset. When you are going to record this in your books, whether these payments are going to affect that payment which you are going to record it in the book or not. How does entity XYZ and customer ABC would allocate these lease payments? So here what they are telling is, in the answer they are trying to explain you that in this arrangement there are two components. One is the lease of the equipment or that machine. That is one, and the purchase of consumables. So in this contract, there are two things. One talks about the mission and the other talks about the consumables. Here, customer ABC believes that it is unlikely to purchase lesser than 8,000 units. That minimum 8,000 units customer ABC will purchase. Okay. So in this example, there is no lease payments for purpose of initial measurement. So for initially, when you're going to record this mission in your books, okay, here you cannot record any kind of a lease payment. Okay, because what happens here is that here you cannot say that because this mission is given at no cost, correct? So here you cannot record it at any price. Maybe a nominal price you will record, but there is no major portion of lease payments here. Okay, so here entity XYZ and customer ABC would allocate the payments with the future payments to lease and consumables component of the contract. So here what they're telling is, in the future, if there is any payment which the lessee is making to the lessor, those payments they will allocate and bring it as a lease component. They will allocate the payment and bring it to the lease component. So here what they're telling is, this, since the customer ABC is not electing the practical expedient to separate the lease and non-lease component, here what they are selling is that, here if you see the purchase of consumable is a good or service. Okay, here the purchase of consumable is like a purchase of goods or services only. But here, since the customer ABC is taking an option, here in the earlier in our earlier video, we have studied that customer ABC as an option that he may or may not separate the lease and non-lease component. Here what happens, customer ABC is not separating the lease and non-lease component. Here the lease component would have been the equipment and non-lease component would have been the purchase of consumable because it is a good. Here customer ABC is electing that option and choosing to not separate the lease and non-lease component. So here everything is going to be a separate lease components. So whatever future payments you are going to make for the consumables, that usually what will happen is that shall actually be your lease payments. That will actually come as your lease payment. Correct. That will be recorded as your present value of lease payment. But here, since the mission is also at no cost, and for the future value that you're going to pay for your consumable also, since there is, it has variability, and you exactly don't know whether that 8,000 units you will consume or not, even though you're sure, but there is no return agreement that minimum 8,000 you have to take, no matter what. Here, it depends, it has a variability and it depends on the lessee. He wants to take a lesser of 8,000 or more of 8,000. Okay, here it's just just predicting that he would use 8,000, but here there is no form of fixed term here. Okay, so here, since it has a genuine variability, this lease payments which we are going to pay for the consumable also cannot be recorded today. So here, on the date of initial measurement, there will be no lease payments which you are going to record. So in your books, it is going to be 0 only. That is what this answer, that's the question is trying to tell you. Did you understand this? Any doubts? Okay, fine. Yes. So moving on to the next question. The next question is illustration 25. This is again related to your variable lease payment. So they are telling there is a 5-year lease of an office building. You are taking office building on lease for how much years? 5 years. And the lease payments are 5 lakh per year. That means every year you have to pay 5 lakh rupees. And there is an additional water charge of 0.50 liter consumed. Okay, in that office building, how much ever liters you are consuming, 0.5%, 0.5 rupees per liter you have to pay. Okay, so here the payments are due at the end of every year. So at the end of every year you have to make payment. Here entity A elects to apply the practical expedient to combine the lease and non-lease components. So here A is choosing that option and he is combining the lease and non-lease components. Usually you show them separately, but at the option of the lessee, you can show them to both together as a single lease component itself. Here, what will be your lease payment value? Here at on the year 0, at what value are you going to record this lease payments? Here, whatever values you think is fixed, you have to record that. Okay, so here only this 5 lakh rupees is fixed at the end of year 0. So this 5 lakh rupees you will record as your lease payment. But whereas the 0.5 liter, you're not very sure how much liters you will consume. So on 0th year, you cannot tell how much liters you will consume. So according to that, you'll not be able to calculate the value. Correct. So you cannot bring it to present value also. So therefore, you will not take this into consideration. But here, one thing that you have to remember is that this 5 lakh rupees, okay. So at the commencement date, entity A measures the lease liability, present value of the fixed lease payment, annual payment of 5 lakhs. So all the 5 lakhs which you are going to pay through the lease term of 5 years, bring all of them to the present value and record it in your books as a lease liability. But when we are talking about here, but when we are talking about this exception, that exception to combine lease and non-lease payment, here there is a very important point that this question is trying to tell you. It tells you that whenever you're taking this, lease and non-lease component into consideration, whenever the topic is about variable lease payment, if the variable lease payment is dependent on usage, here the variable lease payment is dependent on usage only, correct? But what did I tell you? Here, whenever the variable lease payment is dependent on usage, you will never take it into your lease payments. You will always record it in your P&L only. You will record it in your P&L only. So here, even though this entity A is electing to apply the option and combine the lease and non-lease payment, here since the variable payment is payment dependent on usage, you cannot record it in your balance sheet as a lease payment or a lease liability or a ROU asset. Whatever payment you're going to make dependent on usage, variable payments you're going to make dependent on usage, you have to record it in your profit and loss account only. Okay, profit and loss account only. Okay, here, 1 minute. So here, let me read through this. So although entity A has elected to apply the practical expedient to combine the lease and non-lease component, that is your non-lease component of water charge also with the lease component, entity A excludes the non-lease component from the lease liability because they are dependent on usage. Even though you plan to combine, you cannot combine because they are dependent on usage. Okay. So I hope you understood illustration number 23 also. Illustration number, so it was not 23, it was 25. So going on to illustration number 26, this talks about your residual value guarantee. So here what happens is that a lessee enters into a lease and guarantees the lessor that it will realize 20,000 from selling of the asset to another party. It guarantees that if you're going to sell this asset at the end of the lease term to someone else, it will fetch you 20,000. Who guarantees to who? Lessee guarantees to the lessor. Okay, and the lessee determines that it expects that it will owe 8,000 at the end of the lease. That means what happens here is that lessee at the start of the lease in a very, very confident tone tells that 20,000 lessor you will definitely get. But as what happens? But in his mind, he knows that 20,000 the lessor will not be able to fetch. The lessor will only be able to fetch from that asset 12,000. So here the remaining 8,000, since the lessee has promised the 20,000 the lessor will get anyhow, the 8,000 which is is like, here what happens? Lessee determines that it will owe 8,000 at the end of the lease. That means asset will not be able to fetch 12,000. Sorry, 1 minute. Let me take out this. Yes. So here what happens? The lessee expects that the machinery or whatever it has guaranteed will only fetch 12,000. Then the rest of the 8,000, the lessee will only have to pay to the lessor. So this 8,000 will be known as your residual value guarantee. That as a guarantee, the lessee has to pay only. So this will be included in your lease payment. Okay. Let's move on to our final illustration that we are going to see, which is illustration number 27. Just a second. Okay, I think the lessee account is starting from illustration number 27. Give me a minute. Let me check. Okay, so it was from illustration 19 to illustration 26 only. So all of this we have covered, and I hope right now all the points where whatever we have read in theory, we have applied in practical also, and all the points are clear. Is everything clear now? So yes, guys. So now that we are done with the hello. So yes, guys. So now that we are done with our first part of understanding the LESSEE accounting, and we have also done our illustration number 19 to illustration number 26. Now we are going to come into the core part, core accounting. Okay, so how we are going to do the core accounting or core practicals. Okay, so now let's start with the LESSEE accounting. Starting with that. So as you all know what happens, a lessee gets an asset, and this asset which he gets on lease should be recorded into our books, correct? So at the commencement date, when the asset is given or when the asset is made available to use for the lessee, how is the lessee going to record it in the books is what we are going to understand. Okay, so when the asset is taken on lease and is given and made available to use to the lessee will record two things in their balance sheet. One is known as the lease liability on liability side of the balance sheet, and the other one is the ROU asset. Okay, ROU asset means the right of use asset. Okay, so here I'm going to tell you what is lease liability and what is ROU asset. So what is lease liability means? Lease liability means the lease payments that you are going to pay through your lease term. The lease payments that you're going to pay through your lease term. Okay, yes. So here, what does your lease liability mean? So when at the commencement date? So at the commencement date, you have to record the lease liability at the present value of lease payments. At the present value of lease, you have to record your lease liability, that over the lease term, whatever value you are going to pay, you have to bring them all to the present value and then record it in your books as a lease liability. So if you see here, you first record, just a minute, lease liability. Lease liability is the lease payments that you are going to make. So you have to bring all the payments that you're going to be made over the lease term at the present value and record it in your books. How will you bring it to the present value? You have to use a discount rate, which can be either your implicit rate of return, that your IRR, if given in the question, or if not, incremental borrowing rate, as we understood. Okay, so this you're going to first record, and the other thing that you're going to record in your asset side is the right of use asset. So here we have understood lease payments we are going to make. For making that lease payment, you have to, you are going to make lease payment against some asset. You're going to make lease payment against your asset. So with that asset, you also need to record in your books, and you will not record it as a normal asset. You will record it as a right of use asset, because you only have the right to use that asset. So as right of use asset, you are going to ROU asset, you will record it in your books. At what value are you going to record this ROU asset? Is at the cost. You have to record the ROU asset, which indicates, just a minute, ROU asset, which is indicating the right of using the asset. You have to record it at cost. So now cost, how are you going to find out? So ROU asset, cost, how are you going to find out is what we are going to understand. So first, what you have to do is you have to take the present value of lease liability. Okay, suppose your present value of lease liability, suppose 1 lakh, take that value. Along with that, add your initial direct cost incurred by lessee. Like when I was explaining this first mind map, here I made you understand, right? What is initial direct cost. So whatever the total of this is, you have to bring it here. Any cost which has been incurred by the lessee, which was very important for the lessee to incur to get the lease. Okay, suppose an initial direct cost of 50,000 has been incurred by lessee. Add that with it. Okay, and after that, you have to add present value of estimated cost to dismantle or remove or restore. So now what happened was that instead of the lessor giving us the Pani Puri shop directly, what they did was the lessor just gave us an empty land. On that empty land, we set up a stall. So that we could sell the, Pani Puris, and we could make them. Okay. So now when what happens, when we are going to return this land to the lessor had made a condition that when you are going to lessor had made a condition. When you're going to return this land to me, you have to remove this shop from there and give me my empty land back as it was when I gave it to you. So when I gave, that lessor says, when I gave you this land, how it was, the same way you have to give it back to me. Okay. So to restore this land or to dismantle this asset from there, you will incur some cost at the end of lease term. At the end of, you have to break all the walls of the shop and all of that. So for that, you are going to incur some cost at the end of lease term. So this is known as your cost to dismantle, remove, or restore. Okay, that's it. So this cost also, you have to bring it to the present value as on today, and add it to the cost of ROU asset. Suppose that cost is around 10,000. Okay. Yes. And then you have to add any prepaid lease payments, which is lease payment made before the commencement date. So before the commencement date itself, if the lessee has made any lease payments to the lessor, then in such case, such lease payment which has been made before the commencement date itself, if there is any, you can add that also. Okay. And then finally, after adding all of these, you have to reduce from it any lease incentive received before the commencement date. So if it is received after the commencement date, you know how to account it. We already saw that in one example above, correct? So if it is received before commencement date itself, then in such case, reduce it from the value of ROU asset. Okay. So remember, this is before the commencement date. Okay. And this is also the payment made before the commencement date. So only before the commencement date, if there are any payments made or incentives received, you have to reduce it from the cost. And this is how you find out the ROU asset cost. So at this cost is what you are going to record it in your, you will record this ROU asset in your balance sheet. And this is your present value of lease payments. Okay. So I hope you understood this. So at commencement date, you will record lease liability and ROU asset in the lessee's book. Liability on the liability side and ROU asset on your asset side. Okay, fine. Then we have to understand about depreciation. So whenever you're going to account asset in your books, the lessee has to also depreciate this ROU asset. Every year it has to depreciate the ROU asset. Suppose the ROU asset value, suppose here was, let's take a value. Just give me a minute. Okay, suppose we had recorded a ROU asset of suppose 10,000. Okay, and the lease term was suppose 4 years. Lease term was suppose 4 years, and let's assume there is no residual value. And suppose there is no residual value. Then in such case, what will be the depreciation? So this 1 lakh rupees you have to depreciate over 4 years of time. After 4 years, after the lease is ended, this asset should not be shown in the lessee's book. This asset should be out of lessee's book. So the 4 years you're going to depreciate this ROU asset, which is 1 lakh. So every year you will depreciate 1 lakh divided by 4 years into, for 1 year, how much you will depreciate? You will depreciate 25,000. You will depreciate 25,000 and show your ROU carrying value at 75,000 at year end. Okay. So you have to depreciate every year that asset. So here, see, you have to charge depreciation on ROU asset over the lease term using SLM method. Okay, using SLM method, I thought like every year the same amount of depreciation you have to charge. Okay, here what they are telling you is that here we took lease term equal to 4 years and depreciated it in our example. Correct? We depreciated the 1 lakh in 4 years and we found out the depreciation value to be 25,000. This you have to do when there is no transfer of ownership. That means at the end of the lease term, if the suppose at the end of lease term, if the lessee is not going to purchase the asset, then in such case, you have to do this. You have to depreciate it over the lease term. In case if there is a purchase option, and if the lessee is reasonably certain that he is going to purchase that asset, then in such case, you have got two choices. One is the useful life and the other one is lease term. So lease term is the term for which you have taken the asset on lease, but useful life is the life of the asset until which it could be used, whether or not it is in a lease. Okay. So here, since you're going to purchase it after the lease term is going to over, you have to depreciate over useful life or over lease term, whichever is earlier. So if the useful life is 5 years and if the lease term is 6 years, sorry, if the useful life is suppose 6 years and if the lease term is 5 years and whichever is earlier, then you will depreciate it for 5 years. So depending on this, whichever is earlier, you can do that. So lessee is certain to exercise the purchase option. In that case, depreciate over useful life or over lease term, whichever is earlier. In this case, the ownership is transferred. But when ownership is not transferred, depreciate it over lease term. Okay, I hope you understood this. So we have understood this. Now, what about subsequent measurement? Subsequent measurement means at every year end. At every year end, how are you going to measure it? Okay, so at each balance sheet date, what you are going to do is you are going to measure the ROU asset at either cost or revaluation model. This you would have read in the IND 16 PP. Okay, if you have not seen that lecture of mine, I have already uploaded where I have explained cost and revaluation model. You can go and see that lecture to understand better. So at each balance sheet date, you have to measure the ROU value, ROU asset at cost or revaluation model. Okay, so if you are going to pick cost model for if revaluation model, you are going to do directly whatever the revalued value is, that you will record it in the books. No problem. But if you are going to follow cost model for ROU asset, then how are you going to find out the carrying value of ROU asset? It will be cost minus accumulated depreciation minus any accumulated impairment. Okay. So if you do this, you will get the carrying amount of the ROU asset at every year end. Okay. And if there is any remeasurement which you are doing of the lease liability, then accordingly you have to adjust this. This you will understand when we are going through the sums. Okay. So now what is remeasurement of lease liability? We just read the point here now, right? So now we are going to understand what is the remeasurement of lease liability. So when do you remeasure your lease liability? Okay. So what happens usually is that at the beginning of the, at the commencement date itself, you record a lease liability. Suppose at 1 lakh rupees, you have recorded the lease liability. But sometimes what might happen is, suppose the lease term is for 10 years. Suppose at the 4th year end, some circumstance might happen which might force you to remeasure the lease liability. So now what are the remeasurement means? You have to again reevaluate if this amount is correct or not, or if you have to make changes in this amount. Okay. So when are those situations going to arise? We are going to understand when and all do you remeasure your lease liability. Suppose you have to reassess your term. If what happens was that when and all are you going to reassess your lease term? Okay. So if there is a reassessment lease term, then your lease liability will change, because if 1 lakh you are going to pay over 10 years and bring that to present value, the lease liability value will be different. Whereas if you are going to pay 1 lakh over 5 years only, the present value is going to differ. So in this case also, you might have to remeasure your lease liability. So here what is happening? There is a reassessment of lease term. So here what might happen is, first the, what can we say? First the lessee was not whether he will exercise or not. Okay, but after a point of time, he became certainly reasonable. Okay, he was reasonably certain that he is going to extend the lease term. He is going to terminate the lease term. At the start, he was not sure, but after that, he was either made sure that he will extend it or terminate it, or any other changes due to which the lease term has been deferred. So at that case, you will reassess your lease term and remeasure your lease liability also. Okay. Then next is reassessment. Purchase option. So suppose if you are going to purchase at the end, then in the end, you are going to pay some extra amount also. Okay. So at the 10th year end, there will be some extra amount that you are going to pay. So that you have to bring it into present value and add that also to your lease liability. So due to this, you might have to remeasure your lease liability, or at the year 10, you were actually going to purchase, but now you will not purchase. Then you have to remove this present value from your lease liability. So this is also a remeasurement of lease liability. So this is reassessment when you're reasonably certain to exercise the purchase option that I told you. Then because of in substance fixed lease payment also, you might have to remeasure the lease liability. So suppose what might happen was that after 2 to 3 years, your lease liability or lease payment could have increased by 2,500 or increased by 5,000. So if something like this is happening in substance fixed lease payment, or there is some change, maybe because of index or maybe because of rate or something, then in such case, if future lease payment due to change or index or rate, lease liabilities or present value of these payments are changing, then in such case, it will be known as your remeasurement of lease liability. And if the amounts expected to be payable as residual guarantee, Okay, residual value of guarantee, what you have to pay, either increases or decreases in the future. Then according to that, if you have to change your present value of lease payment, then in such case also there might happen a remeasurement of lease liability. Okay, I hope you understood. Fine. So now how are we going to account it in our books is what we are going to understand. So if a question is given to you, how are you going to solve a question? So if a question is given to you, how are you going to solve the question? First step, what you have to do is, you have to calculate the lease liability. First step, just a second. Yes. First step, what you have to do. 1 minute. Okay, yes. So first step, what you have to do is you have to calculate the lease liability. What is lease liability? Present value of lease payment, and you have to first book it. Okay, the second step, what you are going to do is you are going to calculate the cost of ROU asset, and you have to book that ROU asset in your balance sheet again. Okay, once this is done, every year what you are going to do is, first for the ROU asset, you have to calculate the depreciation, reduce the depreciation from the ROU asset, and find out the closing balance of ROU asset or carrying value of the ROU asset at the year end. Okay. Then what you have to do is every year again, you have to calculate the finance cost. So what will happen is that, we have brought all the lease payments to the present value of lease payments. Okay. So what you will do is, when you are recording in your balance sheet, here in ROU asset, what you will do, you will depreciate every year and you will find out your carrying value. And if there is impairment, you can do that also and find out your carrying value every year. Carrying value of ROU asset. In case of lease liability, what you will do is every year you will unwind, you will do something known as unwinding of interest. Now that you have brought it into the present value, you have to take back all the lease payments to the original value also, right? So how are you going to take back all these values to the original value? You have to do plus interest at the discount rate. You have discounted it at discount rate. Every year you have to unwind the interest. That means you have to add the interest to lease liability to bring it back to the original value. Okay, suppose what happened first year, second year. So in the second year, you are going to pay a lease payment of 50,000, but the present value of this 50,000 is suppose 45,000. So in your books, you would have recorded it at 45,000. Now to bring it back to 50,000 at the second year end, you have to add the interest at discount rate, which will be your 5,000 and which will bring back the lease liability to 50,000. Okay. So every year you have to do something known as unwinding of interest, which means you have to add the interest or what is known as your finance cost at the discount rate to it. This interest you will calculate. Suppose your interest rate is let's say 10%. Okay. You will find out this 10% on the lease liability or last return lease liability on that whatever 10% is, that will be your interest. Okay. And then you have to find out the closing balance of lease liability. So if you add this, you will get a closing balance of 50,000. This is your closing balance of lease liability. Okay, you have to find out that. And then in such case, if there is any installment that you are paying, so if you are, suppose every year again, you are going to pay 50,000. So minus 50,000 of installment you have to do, which will be 50,000 again here. And your lease liability will become 0. And your lease liability is going to become 0. Okay. So I hope you understood this. So lease liability, what you will first do, you will first write the lease liability. Every year you will unwind the interest, add the interest at the discount rate, and then you will minus if there is any installment paid, or if there is any lease payment paid. How you have to do that, I'll make you understand. The fifth step is, if there is a question is asked to you to pass any journal entries, you can pass that. Okay. Yes. So now what will be the journal entries be like? So at the commencement date, what is the journal entry you are going to pass? You have to record the asset in your book. So ROU asset account debit, record the liability in the book, to lease liability. Then in such case, if at the commencement date, if you have received any lease incentive at the commencement date or before the commencement date itself, then in such case, for that you are going to receive a lease incentive, means money from the lessor. So when you are going to receive lease incentive, that is money from the lessor, you will write bank account debit, because this is in the books of lessee. So bank account debit, money will come in. And in case if you have paid any initial direct cost, or you have made any lease payment before the commencement date itself, then in such case, it's a payment from your side. So to bank account credit, you have made a payment. Then If what happens is that in case if you have recognized, okay, if you have, once again, so if you are incurring an obligation for these costs, suppose in the question it is given that you have to dismantle the asset at the end of few years, then in such case for that now itself you have to keep a now itself you have to create a provision. Okay, so you have to recognize this when you incur an obligation for these costs. So if you have an obligation, you have to do this entry, which is to provision for dismantling and removing the asset. You have to credit it. So this will be a journal entry at the commencement. Record the ROU asset, record the lease liability. For any payments made, credit the bank account. For any payments, for any payments made, credit the bank account. For any payments received, debit the bank account. This is the journal entry you have to pass. You have to record the asset in your books and the liability in your books. And for any lease incentive received, you can debit the bank account. For any payments made, credit the bank account, or initial direct cost incurred, credit the bank account. And then for if there is an obligation that you have to dismantle or remove the asset, then in such case for that you can create a provision now. Okay. Yes, fine. Then at the end of each year, what you will do? You will unwind the discount on lease liability. That means you have already discounted and brought the lease payments to present value, right? So now you have to unwind the discount and bring it back to the original value. So for that, first, what you're going to do, you have to increase the carrying value of the asset, increase the carrying value of, lease liability. That means you have to add to lease liability the interest on lease liability. So you will increase the lease liability. I told you here, right? When I was explaining, you will add the interest here and minus your installments. So you will do finance cost. That is, your interest will go account to P&L account debit to lease liability credit. That means your lease liability will get increased. Okay. And then when you're depreciating the ROU asset, your ROU asset will go down. So ROU asset credit to depreciation account debit. Okay. This will also go into your P&L. And finally, whenever you make the payment of installments, that means you are going to pay your lease payments. In that case, again, your lease liability will what happen? It will go down. So lease liability account debit to bank account credit. So this will be reducing your carrying amount of the lease liability to reflect the lease payment. Okay. So I hope you understood that. And in such case, if there is any remeasurement, okay, suppose there is any lease modification or any remeasurement or any revised in substance fixed lease payments, all in that case you can remeasure your carrying amount of lease liability and account accordingly. So this we'll understand when we are doing the sums. Okay. So I hope you understood this now, how you have to account for your lessee. So illustration number 27 to illustration number 32 we are going to see now. Okay. Okay, guys. So let's start with the illustration number 27. So in illustration number 27, they are telling you that they have entered into a lease of 10 years, lease contract of 10 years, and they are going to pay a single lease payment at the beginning of each year. So every year beginning, they are going to make a lease payment. Okay. And the initial lease payment is 1 lakh rupees. Initial lease payment here is 1 lakh rupees, and the lease payments are going, that means at the year 1 you have to pay 1 lakh rupees. Lease payments will increase by the rate of LIBOR each year, and the LIBOR is 2%. So every year, so year 1 you will pay 1 lakh rupees. Year 2, this 1 lakh will increase by 2%, and the including of that you have to pay. And third year also 2% will increase, and that you have to pay. Fourth year also 2% will increase, and that you have to pay as lease payment. Okay. Here they are telling the rate implicit in the lease is 5%. That means the discount rate here is around 5%. And you have to now tell that what is the lease liability. So what is the lease liability in simple terms? The lease liability in simple terms is the present value of lease payments. Yes. Okay, fine. So now how are we going to find out the present value of lease payments? First, every year, what lease payments are we going to make? We have to understand. Before going into that, you have to understand the importance of the word beginning. So whenever you're going to pay a beginning of each year, that means if the lease payments are paid at the beginning of each year and at the end of each year, that will make a difference in the question. So here, since they have told that all the lease payments are going to be made at the beginning of each year, here what is going to happen is that, so here how many years is the lease term going to be? Year 1, 2, 3, 4, 5, 6, 7, 8, 9 until year 10. Okay, you're going to have the lease payment. Okay, and the lease payment is going to start with 1 lakh rupees at year 1 and is going to increase by 2% until your year 10. Okay, so now you have found out that also. And what is the discount rate? Discount rate is your 5%. Your IRR is 5%. So now if you discount these lease payments using this discount factor, you will get your present value of lease payment. Now here the discount factor is a important part. So I told you 5%. So directly you should not go into your calculator and find out the first year discount rate and write there for the first year payment. Here, since they have told you that the payments are going to be made at the beginning of every year, that means it means that at the beginning of first year, at the beginning of first year itself, the first payment is going to be paid. Beginning of first year is nothing but the end of your 0th year. End of your 0th year. So at the 0th year, there will be no present value. It's already in present value only. This 1 lakh is already in 0th year only. You need not pull all of the lease payments to 0th year. The 1 lakh is already at the 0th year only. So here you need not discount. So directly write 1 and write 1 lakh rupees. Okay. So here the next is year 2. Year 2 is so this year you are making the payment at the beginning of second year. Beginning of second year is nothing but your end of first year. Find out the discount rate at the end of first year, which will be nothing but 1 divided by 1 plus 0.05, which is 0.952. 0.952. If you multiply this, you will get your present value. For third year, the same way. This is nothing but the end of your year 2. Year 3 beginning is nothing but end of year 2. So here if you multiply it with by 1 divided by 1 plus 0.05, here it was end of year 1, here it is going to be end of year 2. Okay, so if you do year 3 beginning is nothing but year 2 end. So accordingly find out the discount rate and discount it. Okay, so one thing you have to remember is the first lease payment is already at the 0th year, so you need not discount it and bring it to present value. It's already in present value only. So like this, if you do for all the years, then for the 10th year, what will it be? It will be 1 divided by 1 plus 1.05 to the power 9. Okay, it will not be to the power 10 because it is not made at the 10th year end. It is made at the 9th year end, or we can say the 10th year beginning or the 9th year end. So to the power 9. So like that you will find out your present value. So if you do this, you will find out your present value of lease payment, and this you will record it in your books as ROU asset to lease liability. ROU asset is nothing but also the cost, and the cost, first part of the cost is what? Present value of lease liability only. So to lease liability, it will be 8,80,887 and 8,80,887. Okay, I hope you understood that. Now let's move on to illustration number 28. So illustration number 28, they enter into a 12-year lease for a rail car. Okay, on 1st January 2001. So they tell you that the commencement date is 1st February 2001. So from 1st February 2001 only, you will record it in your books. Okay, entity Y, which is the lessee, is going to pay entity Z, which is the lessor, first monthly rental payment of 10,000 upon execution of the lease. So before the lease term is starting itself, they will make a lease payment of 10,000 upon execution itself. At the 0th year itself, they are going to make a lease rental payment. Okay, they are going to make a rental payment of 10,000. Okay. Entity Z is going to pay entity Y again 50,000 cash incentive. So they are going to get a lease incentive of 50,000. This also upon the lease execution itself. Upon the lease execution means before starting the entire lease term itself, they are paying a 50,000 cash incentive. Again, entity Y has incurred 1,000 of initial direct cost. So in entity Y is the lessee. Lessee has incurred an initial direct cost of 1,000 rupees payable on 1st February. That means that is also payable on the commencement date itself. And then there is the initial lease liability of 8,50,000. So here they are telling, here let's read the sentence. Entity Y, which is the lessee, has calculated the initial lease liability as present value of lease payments using its incremental borrowing rate, because rate of implicit return was not readily determined. So because implicit rate of return was not available, they used the incremental borrowing rate and brought all the lease payments to present value using the discount rate and find out their initial lease liability. So according that, their initial lease liability was 8,50,000. So now how would the lessee company measure and record this lease? So at what value are you going to record this lease in your books? So yes. So now how are you going to record it for the lessee? We are going to understand that. So ROU asset, how are you going to calculate? So ROU asset, first is that you have to find out the cost of ROU asset. You have to find out the cost of ROU asset. So for the first component of cost is, first you have to take the present value of lease liability, which is 8,50,000. To that, you have to add any cash if it is paid. So here in the question, you have made a lease payment, first lease payment of 10,000 upon execution of the lease itself. So 10,000 you have to add. And if you have received any cash, you have to minus that. That we already read. We were understanding the journal entry. So here, since you have received a lease incentive of 50,000, you reduce that from the asset. And the lessee has also made an indirect cost of, initial direct cost of 1,000 rupees. That again you will add. So whatever costs are there, you have to add it. If there is any benefit, you have to minus it. Okay, simple. So ROU asset, lease payments are a cost, cash paid is a cost, direct cost is a cost, initial direct cost is a cost. Only this cash received is the benefit, so you minus that. And you find out the carrying value of ROU asset at commencement date, which is 8,11,000, and your lease liability will be 8,50,000, which is nothing but your present value of lease payments. Okay, so this is how you are going to account it in your book. So in the book, if you see, here they have just calculated the initial measurement of ROU asset as 8,11,000, how we calculated here, and they have given the answer. Okay. Next is related to the dismantling cost. Illustration 29. So aircraft you have taken in a lease for 5 years, you undergo a planned check after every 1 lakh flight hours. So after every 1 lakh flight hours, you have to undergo a planned check. At the end of the lease, a check is performed irrespective of the actual number of flights. So usually you do it after every 1 lakh hours. But if at the lease has ended, even though the flight has crossed 1 lakh hours or not, you will have to definitely perform a check. Okay. So here, what lease payments are you going to calculate for the ROU asset? So here they are telling at what price will you calculate your ROU asset. So here they are telling that, if you see here, yes. So they are telling that a provision must be created for the cost of final check. So what they are telling is at the end of 5 years, irrespective of whether you are going to undergo this 1 lakh flight hours or not, you have to perform a check. And to perform this check, you are going to incur some cost, correct? So since it is a definite cost that you know at the start of your lease term itself, you have to create a provision for that cost now itself, which you are going to spend in the future for the final check at the beginning of lease term itself. So these costs must be included in the cost of ROU asset as plus provision for cost, which is going to be incurred at the end of lease term. Okay. I hope you understood this. Related to this 1 lakh flight hours, if there is any planned check, you need not create a provision for that because you are not very sure if you're going to cross it or not at the beginning of lease term. But at the beginning of lease term, you are very sure that you will have to perform this final check. So you record for that. Okay. Next that we are going to learn is the next illustration. Just give me a minute, please. So illustration number 30. So in illustration number 30, they tell you that lessee enters into a 3-year lease of equipment. So they are leasing equipment for 3 years and they are going to pay an annual payment at the end of each year. Here there is no issue if it is at the end of each year. So 20,000 at year 1 they are going to pay, 30,000 they are going to pay in year 2 and 50,000 in year 3 they are going to pay. There are no other elements. And their discount rate is 12%. Okay. And the ROU asset depreciates on a straight line basis. How would the entity account for the same under lease? So in the 0th year, you are not paying anything. At the end of year 1, you'll pay 20,000. At the end of year 2, you'll pay 30,000. At the end of year 3, you're going to pay 50,000. So now all of this, you have to bring it to the present value using your discount rate of 12%. So in the first year, what you'll do? You will do 1 divided by 1 plus 0.12 to the power 1. In the year 2, 1 plus 1.02 to the power 2. And same to the power 3 here you will do and multiply it and find out your present value of lease payments, which is nothing but 77,361. So this is your present value of lease liability. Pull all of these lease payments to present value using the discount rate. And that will be a present value of lease liability. Okay. So this is what they have first found out. First they have found out what? First they have found out your ROU asset, or what we can call as present value of lease liability. They have found out the present value of lease liability. Okay. Here now they are asking how would you account it in the lease. So every year how are you going to account it is what we are going to understand. So what happens is that in the 0th year at the commencement date, what you will do, you will record the ROU asset and lease liabilities. Here since there are no other elements, ROU asset and lease liability value is going to be the same, because both are present value of lease liability, both are present value of lease payment. But in ROU asset there are some other elements, and lease liability there might be some other elements. But here since there are no other elements, ROU asset is going to be equal to your lease liability, because there are no other elements in ROU asset. So it is 77,364, 77,364 what we found out in the start, all the present value of lease payments, all the present value of lease payments. Then, so here how much is the lease term? The lease term here was 3 years. So for 3 years you have to find out. Okay, so what will happen? First, let's take ROU asset. So year 1, year 2, year 3. So end of year 1, end of year 2, end of year 3. So every year end, you are going to depreciate the ROU asset. So first year opening balance was 77,364. When you record it in your books, you recorded the ROU asset at 77,364. In the first year, you will first depreciate. Depreciation is at a straight line basis. So the 77,364, you have to depreciate it over 3 years. So divided by 3, if you do, you will find out the every year depreciation. So it is 25,788. Every year will depreciate the same. And finally, come to the closing balance. Closing balance is going to be 0. Okay, it is going to be anyway 0. So year 1 end, you will get at this balance. So this balance will be the opening balance of year 2. And that if you depreciate, you will come to the closing balance of year 2. The same will be your opening balance of year 3. And if that again you depreciate, you will come to your closing balance of year 3, which is going to be definitely 0, because you have depreciated the entire amount. So this is how you are going to depreciate it. So every year, what entry going to pass? You're going to pass depreciation, that is P&L account debit, to ROU asset. So your ROU asset will constantly keep going down, and your depreciation is going to get charged. So first year it was 25,788, 25,788. Second year also same entry, and third year also same entry. And by third year end, your ROU asset is going to get 0. Here the ROU asset will become 0. Now talking about lease liability. At the starting, this also you would have recorded as 77,364 only. Opening balance. Here, every year you are going to do unwinding of interest. So at the year end 1, you must have unwinded the interest. Interest expense at how much percent? At 12%. So plus interest at 12%. So at 12%, and on what you are going to find out 12%? 77,634 multiplied by 12% will be 9,284. 9,284. Okay. So that is going to be your interest expense for the first year, minus if you have made any lease payments. Lease payment, how much have you made? You have made a lease payment of around 20,000. So minus 20,000 of lease payment you have made in year 1, you will come at your closing balance, which is 66,648. This will be your opening balance of year 2. So 66,648. Again, you have to unwind the interest at 12%. So plus 12% will be 7,998, minus if you have made any lease payments, which is again on year 2, you have paid a value of 30,000. You will come to the closing balance of year 2, which is 44,646. So opening balance of third year will be 44,646, plus again you will unwind interest at 12%, which is 5,354, minus if you have made any lease payments at 50,000, which you have made is 50,000, and your lease liability will also become 0, because all the present value of these lease payments was only brought here. So if you're going to go at the end, this will again become 0. Okay, so for this, every year, what entry you're going to pass? You're going to pass, first you'll pass unwinding of interest entry, which is interest expense account debit or P&L account debit to lease liability, because lease liability has to go down to that value. Here, see, I've done, your, 1 minute. Here your lease liability will go up by that interest value. Increase by that value. Then if you are going to make payment, it is going to decrease. So lease liability account debit to cash or lease rental, whatever you have paid every year. So every year you have to pass all these 3 entries. So that is what they have passed here. So for the first year, they have passed it, and for the rest of the years, they have just shown. Okay, this is the same who you have to repeat every year. So I hope you understood illustration number 30 also. So illustration number 31. So here they tell you that company EFG has entered into a property lease. Okay, they have leased a property. Initially, the lease term was 10 years. And there was an option of 5-year renewal. After that, you can extend it for 5 more years. There was an option. The economic life of the property is 40 years. So economically, you can use it for 40 years, but right now the lease term is only 10 years. And the fair value of the property is 50 lakh rupees. Okay. They also have given an option to purchase. So there are 2 options. One is renewal option, another one is purchase option. A renewal option for 5 years they have given, and purchase option at the end of lease term, you can renew the property. 1 minute. Has an option to purchase a property. So you can purchase a property at the end of lease term for 30 lakhs. So if you pay another 30 lakh, you can purchase the property itself. The first advance annual payment is 5 lakh. Advance annual payment. So here when they are talking about the first advance annual payment, that means annual payment we understand. What is advance? Advance here means beginning. So every year beginning, they are paying this annual payment. So the first annual payment is 5 lakh rupees with an increase of 3% every year. So every year beginning, when you're making the when you're making the payment, your lease payment will increase by 3%. Okay, here then they have told an implicit rate of return or your discount rate is 9.04%. There is a lease incentive given to you at 2 lakh rupees, which is payable at the beginning of year 2. So at the beginning of year 2, you'll get an incentive, which is used for normal tenant improvement. And company EFG is reasonably certain to exercise the purchase option. So here they're not going to renew for 5 more years. They are directly going to purchase the asset. So for them at the end of lease term, they have to pay a value of 30 lakh rupees. Okay. So what is being given in the question? Let's just summarize again. There is a lease term of 10 years and they have a 5-year renewal option, but they are not going to use this renewal option. Economic life is 40 years. Fair value is 50 lakh. Option to purchase they are going to take up, which is 30 lakhs at the end of lease. They will pay and take up this option. So the first lease rental is 5 lakh rupees and every year 3% is going to get increased. Discount rate is 9.04%. They are going to get an incentive of 2 lakh at the beginning of year 2. So whenever you're starting with a lease answer, I would suggest you make a summary like this and start. So I've already told you what steps will you follow in a question. First, find out the lease liability. Second, find out the ROU asset. Third, do the accounting accordingly. Okay, so first let's find out the present value of lease liability. First, find out the present value of lease liability. So how many years lease? Year 1 to year 10, you're going to have a lease term. First, you're going to pay 5 lakh at the beginning of first year, and after that, every year 3% you're going to increase until year 10. Okay. Then what they are telling you is that at the end of year 10, you are going to pay a value of 30 lakh and purchase that asset. Let you write this also. Okay. So here the last lease payment you're going to make at the 10th year beginning. But when are you going to buy that asset? At the 10th year end, you're going to pay 30 lakh and buy that asset. So the discount rate, what you're going to calculate here and the discount rate, what you're going to calculate here is going to be different. Remember that. Okay. And if you all discount this at 9.04%, you can find out your present value. Also, in the question, they are told that at the beginning of year 2, they had made a lease, they have got a lease incentive of 2 lakh rupees. So that you have to reduce from your lease payment. Okay. So this is every year beginning. So year 1 beginning, year 2 beginning, year 3 beginning, and so on until year 10 beginning. And this alone is the year 10 end. So in the first year beginning means what? 0th year end. So at 0th year end, will you discount something? The answer is no. It is already at the present value only. So discounting, you will only put as 1. So your present value will again be 5 lakh. Now let's take year 2 beginning. Year 2 beginning means first year end. First year end is equal to your year 2 beginning. Correct. So here you will discount it, which is nothing but 1 divided by 1 plus 0.09. Sorry, 1 minute. I made a mistake here. Yes. So this is going to be 1 divided by 1 plus 0.0904. 0904 to the power 1, because this is year end 1 only, which is your second year beginning. So accordingly, you will discount, you will multiply these both. You will do 5,15,000 minus 2 lakh, and the pending value you will multiply and find out your present value. And the same way, you will increase every year 3%, and find out the discount rate accordingly and find out your present value until 10th year beginning. Okay, your 10th year. So this is, how did you find out your 10th year beginning present value? 1 divided by 1 plus 0.0904 to the power 9, because 10th year beginning is your 9th year. And yes, I hope you understood that. And you find out your present value of all the lease payments is 37,39,648. 37,39,648. At the year end 30 lakh rupees, you have to find out what is the present value as on today. For 30 lakh, you're going to pay at the year end 10. So nothing but 1 plus 1.0.094. This is paid at 10th year end only. So to the power 10. Whatever year end is that will go to your power. So 10th year end. If you multiply, you'll get 12 lakh 60 as the present value for that. So the total of present value of lease payment is 50 lakh 221, or you can approximately say 50 lakh is your present value of lease liability. So you'll record your ROU asset at 50 lakh rupees to lease liability 50 lakh rupees. So now every year what you are going to do now. So as you can see here, just a minute. So every year what you will do with the lease liability. So the year end one, you will see what is the opening liability. It was 50 lakh rupees, which you recorded the lease liability at. In that you have to, here one thing that you have to again remember is that whenever it is year end, okay, sorry, whenever it is year beginning, one point that you have to importantly remember. Whenever it is year beginning, okay, whenever the question it is given, usually what happens at year end, let me first tell you, then I'll explain about year beginning. Okay, just give me a second. Yes. So what happens usually is that at year end, what happens is that you have gone through the entire year. You have gone through the entire year. And at the end of the year, you first, what you do is that you unwind the interest and then you reduce your installment and then you reduce your installment. But whenever you're going to make any payment at the year beginning itself, whenever you're going to make some payment at the beginning itself, you will first pay the installment, because throughout the year there might, because the installment is paid at the beginning itself, here until the year beginning, there might have not been any interest at all. There might not have been any interest at all. Okay. So after paying the installment at whatever remaining value you have, on that only you have to take your installment. Suppose here, if you see here, we are taking year beginning, correct? So your opening balance was 50 lakh rupees. At the year beginning itself, you paid 5 lakh rupees. So your present value itself now is 45 lakh rupees only. So year one end, the remaining value what you are with is 45 lakh rupees only. Now, throughout the year, you would have incurred an interest or a finance cost, which is 4,06,800. On this 45 lakh, you have to unwind the interest and then find out your balance due. So it is going to be 50 lakh of your opening balance. Here you have to first reduce the installment whenever it is year beginning. First reduce the installment, because installment is paid at the beginning itself. Interest unwinding is done at the year end. Installment is paid at the beginning, but the interest unwinding is done at the year end. So first beginning you will do and then the end one you will do. So at the year end, you have to then unwind the interest. So second year again, you will start with the opening liability. First reduce the lease rental which is paid at the beginning of year. Find out the amount due, and on that find out your interest, which you will have to pay at the year end. And this is how you're going to do your, this is how you're going to pass your journal entries also. Okay. So this is actually not like this. This every year beginning, you will pass this lease rental entry, and every year end, you will pass this interest entry. Okay. This is how you will find out your closing balance. And that's how it's going to go on until the 10 years. For 10 years, they have given you here. Okay. As you can see in our book also, first the payment, first the opening balance they have taken, and they are first paying the principal at the year beginning. Then they find out the interest which is to be calculated at the year end, discounting. So interest expense and the lease liability, they find out the closing year. So you should remember, if it's an end, then first add interest and then remove the installment from it. If it's your beginning payment of installment, then first reduce installment because it is paid at the beginning, and then add interest because it has to be paid at the year end. Okay. I hope you understood this. And then, so that was all about your lease liability, how you are going to record your lease liability every year. And your ROU asset, you have to depreciate it every year. Okay. So this is what your question talks about. I hope you understood illustration number 31.